If I told you that one of the core companies powering the entire AI boom still has a growth rate the market hasn't fully understood yet, will you look at this stock differently? A lot of people talk about Nvidia by only looking at the stock price and hype. But what really determines long-term returns is whether this company can consistently turn demand into real profits over the coming years. In this video, we're putting emotions aside, ignoring the noise, and breaking down Nvidia itself. Hey everyone, this is Stock Market Breakdown. Today, we're talking about Nvidia. I'm not here to tell you whether you should buy right now, and I'm not going to predict short-term price movements. What I care about is whether, from a business and data perspective, Nvidia is a company being driven purely by market emotion, or one that's consistently generating real, sustainable profits. Nvidia was founded in 1993 and originally focused on gaming graphics cards, but today, Nvidia has completely transformed into core infrastructure for the AI era. Most of the AI models you see today, whether they're being trained or deployed, require massive amounts of high-performance computing, and the core of that hardware comes from Nvidia. Microsoft, Amazon, and Google are among its most important customers. From this perspective, Nvidia is no longer just a chip seller, but a company positioned at the very foundation of the AI industry. To really understand Nvidia, you can't just look at it as a hardware or chip company. You have to see it within the context of the entire AI value chain. As long as computing demand continues to grow, whether from cloud services, large language models, or automation, Nvidia's position makes it extremely difficult to replace in the short term. In December, Nvidia made a move that's worth paying attention to. The company entered a deep partnership with Synopsys and invested roughly $2 billion. Synopsys provides chip and complex system design software, tools that engineers rely on heavily during the development process. By embedding AI capabilities into these workflows, Nvidia is positioning itself so that more and more development work naturally depends on its platform. Once those workflows are established, switching away becomes extremely costly. What really matters here is that Nvidia is no longer just selling computing power or chips. It's starting to influence and control key entry points in development and workflow processes. Once those processes are locked in, reliance on the platform grows stronger. And that kind of control is often far more valuable long-term than any single product generation. Looking at the financials, Nvidia's growth isn't just surface-level hype. In the latest quarter, revenue grew more than 60% year-over-year, reaching $57 billion, even as the company begins shipping its new Blackwell chips, which come with higher early production costs. Gross margins remain above 70%. The level of profitability is extremely rare in the semiconductor industry. More importantly, revenue growth and profit growth are moving almost in sync, showing that demand isn't being driven by price cuts. This tells us Nvidia's growth has real substance behind it. It's not a company selling more while making less. Instead, nearly every wave of revenue growth is translating directly into real profits. That kind of growth reflects strong pricing power, solid demand, and a business model that's working as intended. Now look at the balance sheet. Nvidia's financial position is equally strong. The company holds a large amount of cash, and its total assets far exceed its liabilities. This gives management a lot of flexibility, whether it's continuing aggressive investment in research or navigating industry cycles. In an industry as cyclical as semiconductors, financial stability itself becomes a major competitive advantage. And because of that, even when market sentiment becomes volatile and capital rotates quickly, Nvidia is still able to maintain control of its own pace. It's not a company being dragged around by the environment, but one that can rely on its orders, cash flow, and demand to move through cycles. Looking ahead, investor focus remains on high-end computing products and evolving service models. High-end chips within the Blackwell architecture carry higher pricing, stronger performance, and better margins. At the same time, offering computing power through cloud-based access rather than one-time, hardware purchases, creates more stable revenue, and pushes the business closer to a software-style model. That shift has a significant impact on long-term profit structure. Overall, Nvidia is not a low-risk stock, but its position in AI infrastructure, profitability, and long-term potential are very clear. Whether it's right for you depends on your investment horizon and your ability to handle volatility. This is Stock Market Breakdown. I'll see you in the next one.